Welcome to the HouseCalc Mortgage Explorer tutorial. So today I'm going to show you how you can understand more about home mortgages and how they all work using this wonderful new app called HouseCalc. So first you're going to have to download it from iTunes, and once it's on your device, go ahead and launch the program. The first screen that's going to come up is your monthly payments. This is your basic mortgage calculator. It's going to have your fields such as the purchase price of your home, down payment. Here you have an option. You can either put in the dollar amount that you're going to put down, or you can put in the percentage. Interest rate. Of course, you can adjust your interest rate using a slider. This is great for seeing how the interest rate affects this pie chart down at the bottom and how it affects your total monthly payments. Or if you already know the specific interest rate that the bank has guaranteed you for a specific mortgage, then you can enter that in this field. Loan term, you can choose between 15 and 30 years. And again, this chart will automatically update for you. Private mortgage insurance is only applicable if your down payment is less than 20%. So for example, suppose we only had $20,000 to put down for the house rather than the 20% we need. Now the private mortgage insurance is active, and we can see here that it's included. The pie chart breaks down what percentage of your monthly payments go to the PITI. So that's principal, interest, tax, insurance, and of course the private mortgage insurance if that applies to you. When you rotate the device, instead of the pie chart, you can see the amortization over time. Here, the private mortgage insurance, you can see you only pay until your loan to value ratio is at least 80%. Once that happens, then you no longer owe the private mortgage insurance, and those payments will stop. So those aren't included in your total monthly payment because it's an add-on that you only pay here for about the first 5 years of the mortgage under this scenario. So in this graph, again, you can adjust the loan term, and you can use the slider to see how that's going to affect your monthly payments and what percentage is going where. And here you can see this is your principal, and over time the amount of your monthly payment that goes towards the principal increases as the total interest that you pay each month, interest that you accrue each month goes down. Okay, that's your basic mortgage calculator. Now you can see your monthly payment schedule in this section. Here we have over time. You can choose your start date for the mortgage. It defaults to today, but you can of course change that if you plan to start it in March, and then you can see what portion of your monthly payments will go towards the principal and interest. Now this does not include the homeowner's insurance or the property tax amounts because those amounts don't change over time. They're just fixed. Now if you rotate, then you can see the tax incentive. So what this tax break is telling you is you can deduct your interest that you owe and also your property tax from your federal income tax. So you'll do that at whatever your federal income tax rate is. Here we've selected 28%. But you can see, the higher your rate, the bigger your deduction. And this tells you your net payment is going to be your total monthly payments minus this tax break. So this is effectively what your monthly payments on the house are. This is not what you owe the bank. You still owe the bank whatever your total mortgage amount is. But that gives you a nice sense for planning your finances. Okay, next up is the rent versus buy calculator. So this one is to figure out, is it better to buy a house or to rent, just from a financial point of view. Here, again, you're going to enter the same information that you entered on the monthly payment section, and we'll put here, let's put the down payment percentage back to 20%. Okay, and now we're looking at this scenario, and the question is it better to rent or buy? Anything you change here, I should say, your monthly payments will automatically change, so you can see our monthly payments are around $1,000. And our rent, let's say, is about $600. So you're paying a lot less in rent than you would pay in your monthly payments. But here's the thing, you're really leveraged on a house. So the appreciation rate here applies to the full value of the house, not just your down payment, the money that you have in there. The savings rate, well, that affects if you took that $30,000 and instead of putting it towards a house, you put it in an interest-bearing account at the rate of, for this example, 2.5%. It says how fast will that money grow? Now again, we need your tax information here so that we can figure out when you sell the house how much you're going to owe the government. And there's certain limits that differ based on whether you're married or single. Those may come into play depending on how expensive your house is. So that's why that information is there. And here the scenario tells you that 7 years is the magic number to stay. But if you want to see where that comes from, rotate. And now this blue line is if you put that $30,000 into the bank at this savings rate. And every month, that difference that you pay in your rent is $400 less than your mortgage payment. So take that $400 every month and stick that in the bank too. That's what this blue line is tracking, how fast that money grows. The green line is tracking your home equity. So initially, your home equity is about $30,000, your down payment. But as you make monthly payments, whatever portion goes towards your principal will increase that amount. And also, the whole value of the house is increasing. So this is what the green line is tracking. And you can see the green line is growing faster. And they cross right here around 7 years. Now, if your house is appreciating faster, well, it just gets better and better to buy. On the other hand, if you have a really good savings rate, then you can make these guys meet. And sometimes, here's an interesting one, sometimes they just meet all the time. There's this point here where the loan matures, and it looks like there, okay, well, the buying was better, but that's after 30 years. So you can see here that in this particular scenario, you're doing about the same for the first 30 years if you buy or rent. And if you look back, the calculator will tell you that you should probably look at the graph under a scenario like this. And of course, if you want to see what's the actual difference, not just when's it better to do what, and let's put it back at a reasonable rate, you can see that, oh my gosh, out to here, I'm doing about $50,000 better to have bought. Whereas, if I'm only planning to stay for about 15 years, it looks like I'm only doing about 20,000 better. So it's up to you really if you want the stress and the pride of home ownership. And those are the two options that you can look at. And the final option, this mortgage calculator, is the maximum mortgage. So this is going to tell you what the biggest mortgage you can afford is based on your income. So you need to enter that. The amount of money you have saved up that you can use towards things like your down payment, your monthly debt. Let's actually increase this one. So suppose your car payments are $350 and you have $100 of credit card debt a month that you're paying off. Well, there's your monthly debt. And let's suppose your income isn't quite that high. Let's give you $70,000 a year, but you've saved up quite a nest egg here of $50,000. Okay, then this is going to tell you, you put in your, of course, interest rate and all of your loan information, and then you're going to say, what's the biggest debt to income ratio that I want to have? So the general rule of thumb is about a third of your income should go to the home ownership, but you could set that up if you wanted, higher to maybe 40. You really don't want to go above 42%, so the slider will not take you there, but you're welcome to enter that into the text field if that's something that you're interested in looking at that scenario. Your down payment, again, 20% is a good amount to put down. If you're willing to put down only 10% and have that private mortgage insurance kick in, then you can adjust this slider as well. And you can see that as it goes down, okay, the private mortgage insurance is definitely kicking in there. And then we put it back to 20%. And then cash, what's cash? Well, it could happen that you have some furloughs, maybe you get laid off, or there's a medical emergency that suddenly impacts how much money you have every month that you can put towards your mortgage. Well, the cash reserve is the amount of money you keep in the bank in case an event like that happens. So saying 9 months means I'm going to keep 9 months of my mortgage payment in the bank just in case. And that's money I'm not going to touch, and I'm just going to keep it as a safety net. Generally speaking, you should have at least 6 months. Of course, again, you can enter in the text field. If you wanted to go down to something like 2 months, you could do that. And the calculator will let you know that this is probably not a good idea, but it'll let you put in that scenario just to test it. And now we'll put this back up to 9 months, which is a good amount. 9 months is a good amount to have. And it's telling you under these conditions, the maximum home price you can have is $183,000. Your monthly payments will be $1,150, and your down payment will be $36,651. So you can see the down payment isn't quite your total savings, and that's exactly because of this cash reserve. Right? You can see as your cash reserve goes smaller, your down payments, the amount that you're actually putting down on the house changes. One thing to notice is here, when I'm changing my debt to income ratio, it doesn't change for a long time. That's not a bug. If you rotate the device, you can see why that's happening. Each of these 3 constraints is depicted as a line. So in order for a debt to income ratio to be below 33%, your mortgage needs to be below the blue line. So you can see that we want to end up below all the lines. So if I'm moving my debt to income around here, it's not actually affecting where that red dot is. But once I come down here, okay, now it's moving the red dot. That red dot is the maximum home you can afford. So that's why it doesn't really affect us when we're up here. So similarly with the down payment, if you want to keep your down payment at least 20%, you need to be below this line. And if your down payment, if you're willing to put only 10% down, now you're in this scenario, and here your debt to income ratio matters a lot more. And the same thing with the cash reserve, it affects this line. And really, the mortgages that satisfy all of these constraints are this gray area, the allowed mortgages zone. So you can see, well, what's my biggest constraint? Well, if the debt to income line is where these guys meet, that means that your income is your limiting factor. And in order to afford a bigger house, you need to find a way to increase your income. On the other hand, if your down payment is the leading line here, then that's telling you that you haven't quite saved up enough money for a house. So you need to save more in order to afford more of a house, or you could put less down and you could go with a private mortgage insurance, or you could do a piggyback mortgage, something like that. This calculator doesn't calculate for a piggyback mortgage, but that's pretty simple to add in the extra mortgage, and you could just look at two scenarios. So there we go, just to review. We have your monthly payments, where you can figure out exactly what your monthly mortgage payments will be. Payment schedule with a tax incentive, so that you can see how much you're going to save every month off of your monthly payments in terms of a tax rebate from the government. Your rent versus buy calculator, so you can see when's it better to rent and when's it better to buy. And the maximum mortgage, so you can see what's the biggest home, most expensive home that I could afford given my risk factors. And again, you can play with that to see how they really affect things. And the idea is to use these interactive graphs to get a better understanding of your mortgage and how it all works, so that you can feel comfortable with whatever loan you decide to get. So that's our app. I hope you enjoy playing with it. And if you have any feedback or comments whatsoever, please visit us online at pengoneapps.wordpress.com.